President Trump for also because the fund that Robert runs is up because of President Trump. Exactly, Wayne. And the stock market is up because the S&P, Robert's fund is beating the S&P 500. He's going to tell you why it is, partially because of Trump, but also because of Robert Maltby. That's why it's beating it also. And Singular Research, if you haven't heard of us, he's going to talk about what is ahead, the silver linings ahead, exclusive. He'll talk about a deep dive is to why silver and silver equities may be the most undervalued and overlooked opportunity in today's volatile macro climate. So he'll talk about that. And if you don't know us, I'm Alicia Vegas, Vice President of Singular Research, and we do run the research side of the fund, is why he knows what's going on in the stock market, because he does deep dive research in Singular Research. So we do have 110 institutional clients at Singular with 70 billion in assets under management. And Robert does have over 40 years of Wall Street experience, and he's a VP of a major investment top-rated mutual fund by Morningstar, and he is the first analyst that did identify the Magnificent Seven. And so he's going to talk about what stocks you should be looking at that he could help you invest in if you come in the Argonaut 2000 Partners Fund, which Robert runs. So this is the president, Robert Maltby of Singular Research, and the Argonaut Partners 2000 Fund. And you can ask questions about how do you get started in the fund, and what do you do, and how much you would need to come and join us in the fund. So this is the president of Singular and also the Argonaut Partners 2000 Fund, Robert Maltby. I have cards for all of you if you need.
Thank you. That was great improv because you jumped the script totally. That's okay. I'm going to launch the presentation. Bear with me a moment. Hello. Yep. Uh-oh. Uh-oh. I have to do this. Here they are. Okay. Okay. Buried in my pocket here. There we are. I can see again. Okay. Thank you, everybody. We're going to start right now. Chris? Jim? My analyst in the machine here?
Yeah, sure, Robert. Which presentation do you want me to put up?
Can you hear me? All right. Wait. All right. So thank you, everybody. We're going to cover a few pretty interesting things here. That is me on the cover of Time magazine. It's pretty aspirational. If President Trump can do it, so can I, right? So next slide. The tower slide. That's our the blueprint of our skyscraper in Manhattan, also aspirational. Next slide. Okay, I like this slide because it's also aspirational, but grounded in truth. If, you know, the Los Angeles Lakers were just sold to the guy that owns the Dodgers, and he paid $10 billion The Buss family bought the Lakers for $57 million. All right, a lot of numbers there. That's a darn good return, right? So if the Buss family had invested in the Argonne Fund in 1979, when I was a high school senior running my hedge fund, I'm taking the compound annual returns that we've had in the fund. They would have 70 billion. And the point is not all that money, because after all, what are you going to do with it all? It's the power of compounded long-term returns. The Lakers, that investment averaged 13%, 13.3. Argonne has averaged 16.7. Doesn't seem like much of a difference, but over 45 years. So I'm here to encourage long-term investing and patience. Next slide. Okay, I'm gonna just quickly fly over what our strategy is and how we got there and where we're going. Next slide. It's the table of contents. Next slide. So the Argonne Fund is named after Jason and the Argonauts of Greek mythology to slay all those beasts in the market to find the golden fleece. That's our goal. Next slide. So our view is to go find companies that are forgotten, forlorn, discarded, that don't need money, don't need banking money. They're cash flow positive, under the radar screen of Wall Street, and get there very early and invest very early. The difference mathematically between companies that lack coverage or have no coverage and those that do is about 20% a year. Think about the 3% spread, then look at this 20%, and that's annual and repeatable. That's our strategy. Next slide. This talks a little bit about how we relate to singular research. Got 8 analysts, cover about 50 companies, and Argonne Fund is powered by that IP. That's where we get our juice. That's where we get our gasoline, our momentum, and our alpha. Next slide. Management structure is me. I wash the bottles. I take out the trash. Now, actually, we've got our 6 analysts, and I ask them to take out the trash sometimes. But we're lean on expenses. That's the point. Next slide. I can't see that, but that's my timetable from when I started in the industry with a firm called Morgan Stanley. It's now called Morgan Stanley. It was called Dean Witter. Then it became, what did it become after that? Morgan Stanley. And well, no, I went to Smith Barney. I tried to escape. And they came and got me. They found out I was there. So they bought out Smith Barney and it became Morgan Stanley. So I kind of ended up. Next slide. Okay, this is our staff and our analysts that covered this already. Next slide. This is our strategy. A little bit more in the weeds of what I basically explained, which is we look for these companies, our analysts are out there, we look at 2,000 companies a year, and our goal is to find the top 2%, about 40 companies. Next slide. This again underscores graphically the difference between companies that have covers and don't. It's meaningful and it's repeatable. Next slide. A little bit about the process. That's the wheel. That's the fortuitous wheel, research to money. Next slide. A little bit about how we get our ideas. Basically, our analysts have had prior lives and experience with different firms. They bring us ideas. We also have our screens that I talked about, the 2,000 names. And of course, in the course of daily life, we've got an open platform for phenomena you might see. Like you notice that there's this new crypto coin, right? And it's called Kraken or something, and it's traded on Coinbase. Well, Coinbase has been a huge stock, but we found a lot of some other interesting ideas that way. Next slide. So this goes into the process again a little bit in the research. Next slide. Yeah, it's how we select our companies. More details on that. Next slide. I want to get to the good stuff, the stock picks. Yeah, our portfolio is 20 to 50 names. We also short companies. We look for bad merchandise out there, companies that are overvalued, overpriced, overhyped. And there's a lot of them. And there'll be more in this bull market. So we go both ways, but at the same time, we'll be long and short. Next slide. We also use macro. We're sensitive to the overall economy, the political economy, interest rates, employment, and other inputs to give us a reading on the environment out there. Next slide. Risk management, we use ETFs to quickly manage our risk. As you all know, ETFs are a quick way to get in and out of the market. They're a very quick way to get short when you need exposure and to get long when you need exposure. And then later, you can pick your stocks. Next slide. A little bit about the terms and the size and the administrator. This is all kind of your index at the back of the book, and it'll be in our documents on our website. Next slide. My bio, we covered that already. Next slide. This talks about our performance year by year. We had one down year, and this year also up. So what would that be? 6 for 7. Next slide. This shows it graphically. Essentially, I like to talk to people about the long term and doubling and tripling your capital, your wealth over a 5 or 6, 7-year period, and get away from the day-to-day and the monthly battles, and just let the statistics, let the analysts, let the investment strategy do the work. So this shows our returns versus other things. I don't know if anybody can really read this, but let's just say that we're outperforming the indexes by pretty wide margins. Our compound return 18.8 at the end of 24 versus the Russell 2000 at 9, the S&P at 16, and our benchmark, which is the hedge fund long short index, at 6.5. Next slide. This shows the compound growth over time. Next slide. A little bit about how we're diversifying in different sectors. Make big bets. We're looking to hit singles and doubles consistently versus, swinging for the fence. Next slide. A couple of stocks. This was a big winner for us, Roku. You may know this. This is an example of your experiential feelings. I was in Best Buy, and I noticed that it's like 6, 7, way back 8 years ago. And every 7 out of 10 TVs had smart TVs. It reminded me of when computers came out with the Wintel. They had Intel chips, Windows all over them, Microsoft. So Roku was all over the map here, dominating streaming. So bought the stock and then went from 40 to 400. So that carried a bit of our return. Next slide. PriceSmart, they're the price club of the Caribbean at the time, just same business model in a relatively untapped market. From the thatch huts to the price club, big difference. And that was a big winner. Next slide. Stamps.com, near monopoly. They had an exclusive arrangement with the USPS, US Postal Service, and that helped them a lot until they gave it up. They had to give that monopoly up. So we got out of there. Fortunately, towards the top, big winner for us. Next slide. I'm not going to talk about it except to say we lost about 15%. And we'll have other losers. The way we handle this is, let's say we're right half the time. If our winners can go up 50% and our losers only go down 15%, help me with the math. That's a winning equation. The point is, cut your losses before they cut you. Next slide. So we got the singular research. This is the backdrop of our universe of selection. As you can see, over the long term, it's outperformed the Russell by a lot, 694% versus 307%. That's just a couple points a year over 24 years. Next slide. All right, that's just a little bit about in the weeds about our indicators that we look and we try to equate how aggressive or unaggressive we're going to be. I'll tell you a quick funny story. I remember in 08, before the subprime disaster, we had a conversation with a journalist at the Wall Street Journal who was talking about all this debt out there and all this, leverage in the system. And I said, what are you talking about? The banks, they're regulated, right? So I had a little bit of a disagreement with her, but then I went and checked it out. And she was right. Turns out that the banks were levered like hedge funds, 20 to 30 to 1. So it only took a small movement. And that was when the subprime market started to collapse. When those mortgages came down in price, we would have been still digging out of this thing if we didn't have the government step in and save the economy. So the indicators I put a lot of weight on to keep a look at the big picture. Right now, the big picture looks fairly good. You don't see a lot of excess in the system in terms of leverage. In fact, there's $7 trillion in cash on the sidelines. And to put that in perspective, that's about 12% of all the market value, equity value, and the norm is about 7%. So there's a lot of excess cash there to be deployed yet. So you're not too late if you're a bull. Next slide. Okay, that's it for the Argonne piece of it. Now we're going to move to our analyst, Jim Maroney. Jim is in Ontario, Canada, the 51st state, right? Right, Jim? No, he's in New York City now, Goldman Sachs, teaching the investment bankers how to get deals done. But he's going to present. He is our strategic minerals analyst, and he'll share some of his ideas and outlook on silver and silver equities that we think look pretty attractive. Are you ready to take it away, Jim?
Yeah, can you hear me there, Robert?
Yeah, we can. All right.
Okay, great. I hope I come in clear.
Yes.
Okay, great. So, well, thank you for having me. Yeah, I'm going to talk a little bit about commodities. Great presentation so far, pretty tough to follow. I hope I can be just as compelling as the previous speakers. I didn't realize it was going to be a Trump rally there, but being Canadian, I'm all for being the 51st state. I've been telling Robert to sponsor me and give me a visa, but you know what? If we become the 51st state, I have no problems with that neither. So I look forward to seeing what happens with regards to that. With regards to Robert's presentation, really interesting story. I congratulate him on the growth. I wish I had the same kind of growth profile, but I kind of finished at 5'9", maybe 5'10" with the right kind of shoes. But with regards to my presentation, I'm going to be talking about commodities. And so when we talk about commodities, all of the commodities have been really had pretty decent performance as of late. And usually as a group, all the commodities seem to outperform. So whether it's gold, whether it's silver, whether it's platinum and the other precious metals, they all seem to go up and go down at the same time. But however, within the commodities, some outperform others. And maybe I'm going to share a little bit of insight with regards to that. So specifically, I'm going to talk about silver. Now, first of all, we're going to talk about the commodity, and then what we're going to talk about is specific companies that specialize in silver. And maybe that might be a more compelling investment, but we need to talk about the commodity first. But before I start talking about the commodity, I would like to kind of talk about just the overall market. So we've already touched upon it with Robert's introduction, that the stock market is at record highs right now. And, that's great. And there may be further upside to the stock market, but we all know that the stock market cannot continue to outgrow the economy or the rest of the world, for that matter, right? Because that's not sustainable, right? To have a growth that continually outgrows the rest of the economy. So, you can almost anticipate a correction, and we don't know how bad that correction could be. And so the reason why I say that is because if you look at equities as an asset class, you really have to be a stock picker, because even, in the past decade, the past 10 years, even if you picked a bad company, it would go up just because for the fact that the market went up. But now you have to be a really good stock picker. You cannot pick blindly any company and expect that it's going to go up with the market. So I wanted to start off with that. And so you have to either be a good stock picker, or you have to kind of think of other asset classes that have underperformed relative to, the broad market. And commodities is one of those asset classes. However, it has had recent improvement over the past year or two. And, I think we could all see gold as being one of those really good performers. And, a lot of analysts are predicting that it's got further legs to run. But when you want to look at gold versus silver, it's trading at a multiple at record highs. And what I mean by that is gold has considerably outgrew silver. And if you see on my screen here, there's a number called 93 times. So let's just round it to 100 times. So what this is saying is, gold we know to be at around $3,500 an ounce, and silver is around $35 an ounce. So that is 100 times more. Gold is worth 100 times more than silver. Now, historically, that ratio is about 50 times. So, can gold continue to outperform relative to silver? Well, when things go up, eventually they come down, right? And there's this idea called a mean reversion. And so maybe silver might be one of those commodities that is primed to be mean reverting, in that it cannot continue to be traded at 100 times and may mean revert to 50 times the way it has traditionally performed with respect to gold versus silver. So silver has, you can look at it as being undervalued relative to gold. However, there has been some trend upwards with regards to silver too. So it's a compelling commodity considering the trend and its undervaluation with respect to gold. It has seen considerable investor flows, particularly into the ETFs. So not only is there a favorable market, but there's also, some real demand behind it, and that real demand, which you need in any kind of asset class, is the industrial demand. So we've also all here heard in the news, a little less reliance on foreign countries with regards to resources, such as China, a little bit more emphasis on domestic production. So, it's addressing the supply shortages and addressing on local production. Also, there's the demand side, right? So a lot of industries are also investing in commodities, ensuring that that supply is there, whether it be technology, whether it be, microchip, whether it be electric vehicles. So there is that driver that's behind the price for commodities as well, particularly silver, because silver is an important component in so many things that we use in our world today. All right, so all of this provides a bullish backdrop in owning silver equity. So the commodity as itself is very promising. Now, if you're an astute investor, you wouldn't necessarily invest in the commodity. What you want to do is select a company that focuses on that commodity. And what you enjoy from that is the operating leverage and the financial leverage. So it magnifies the gains by investing in a specific company. So what I've done is highlight for you two companies that we particularly bullish about. The first one being Pan American Silver. Now, doing a discounted cash flow analysis, if you do a valuation model on a spreadsheet and you discounted those cash flows, and we have a very modest assumption in the growth rate of 3%, and you discount it for the risk that's involved, not only in the commodity, but the operations of this company. Discounted at 10%, which is, again, another very conservative assumption. You have an implied value of $35 per share, and that's very conservative because it's currently trading at approximately $30 a share. So we have a conservative upside of only 20%, but should silver outperform the way we anticipate it to be, you could potentially see maybe 30, 40, maybe even 50% upside. This upside is going to be more profound with regards to commodities, and particularly companies that specialize in commodities, than other asset classes, okay? Because, well, there's just more volatility with regards to this type of asset. Now, that's one type of analysis we could do. The other analysis is looking at the book value. So what the book value is of a company is basically the equity value. So I'm sure we've all taken maybe an accounting class in high school or university. I'm not really sure what your audience is, but we know what a balance sheet is, and it's assets on one side and debt and equity on the other. And if you look at the equity section of a balance sheet, really this is what you're buying when you buy a share. You're buying the equity value of the company. Now, the balance sheet value of this Pan American Silver is about $27 per share. And again, it's trading at $29 a share. So what you are doing when you're purchasing it, you're basically purchasing this company at book value. So that's about a 1.1 times to book. Most companies, you have book value and market value. And the market value really outsizes the book value of the company, because what it does, market value takes into account, a lot of the intangibles of a company, the brand name, all those things that you can't really touch. So what I'm trying to say is usually for companies, there's a big difference between the market value and the book value. Not so with Pan American Silver. It's trading near book value. What that does is provide a floor, because listen, folks, the price cannot fall that much lower below its book value. Okay, so another compelling factor into this investment. It's backed by management. Management has provided commentary with regards to their operations. They see their reiterated full year guidance with improving margins, so long as the prices continue to remain and go up. So what we have here is just like a price chart, and we could see it's trending upwards. And again, we anticipate that trend to continue to go up. So Pan American is one name, Wheaton Precious Metals is the other. Very similar story to Pan American. We first start our analysis with a discounted cash flow, a modest 4% growth assumption. But oftentimes these companies, they either, when they do bad, they do really bad, and when they do well, they do really well. So 4% growth is a very conservative measure. You can, anticipate even a higher growth than that. Discounted by 10%, again, another conservative measure reflecting the risk. And we come up with a share price of about $60 per share. That's 15% upside from where it currently trades at $52. And again, 15% is a very conservative measure. You can anticipate that it could go up even higher. Now, that's one factor or one step to the analysis. The other analysis is, again, punting the discounted cash flow model and just looking at the balance sheet. And when you look at the balance sheet, we have a net asset value that trades around what the price per share is. Now, what is net asset value? Going back to that balance sheet again, you have the asset side of the balance sheet and you got debt and equity on the other. When you net asset implies you take the assets of the company and you deduct the debt from it. Well, if you took the assets and deduct the debt, you end up with equity value. So your net asset value, again, is equity value. And this company trades at its book value as well, about 1 times. So what that does, again, is provides a floor. So you have nothing but upside. Should it go up, market value will outperform its book value. And should it go down, there's downside protection, because again, the price of a company will not fall all that much lower than what its book value, or in other words, equity value, will be. The management of this company has reaffirmed its guidance based on healthy margins, operations in jurisdiction-friendly jurisdictions, and they have great cost control as well. Another price chart, which we've seen, which you can see recent upside, which we can anticipate to continue to trend upwards. Now, those are 2 specific names. What investors also like to do is perhaps invest in a ETF or a mutual fund. And what that does is just invest in a number of companies, and it diversifies that risk. And so the one I picked out is iShares Silver Trust, SLV for its ticker. And what it has is a bunch of miners in it. and we could see upside of 25 to 30% if silver holds at $40 per ounce. But I have to say, when you pick a single name, you don't have that diversified risk. So when you pick a single name, you can knock one out of the ballpark. It may end up being a dud. You don't know. That's the risk involved. But with regards to an ETF or a mutual fund, you won't have that stellar performance like the names that Robert was mentioning, such as Roku or Stamps.com. But you can see the price chart for the ETF. This too has trended upwards recently, and we can anticipate further upside for the rest of 2025 and into 2026. So just some of the factors that support silver: macro tailwinds, price strength support, mining profits, valuations. The leverage effect of the miners, as I said, the mining companies have operating leverage and they have financial leverage, making up total leverage, which will magnify gains, okay? It also magnifies losses, but we don't anticipate losses going forward. Again, the book value supports a valuation floor. The discounted cash flow also supports our thesis as well, and management as well has backed up what their operations are. So as a summary, silver equities look currently attractively valued. The macro drivers support it. Our DCF points out to 15 to 25% upside. The book value is trading, it's trading near its book value, and management has reaffirmed their operations. So Robert, I'll end it with that and I'll pass it over to you. Thank you.
Well, thank you, Jim. You're welcome down here anytime. I have an open spare guest room, so feel free to come down. Thank you again, sir, for Jim Marone. Just got to get up bright and early and teach all the new Goldman Sachs investment bankers to make millions. Okay, now, Chris, if you can cue us up for the next slide. We're going to have a very quick discussion of rare earth elements. Now, here's how you win the door prize. Name me 3 rare earth elements. Anybody? Do I hear 2? What? Uranium is, I'll have to check that. Get back. Do I know 1? We'll see. Name, you can't Google it. No Googling allowed. You got all 17, right? Okay, I'm going to tell you the one I know but can't pronounce. I practiced this for 5 minutes and I still can't pronounce it. So here we go. It is nibba-dibba-dibba-dibba. Nope. It is beryllium, neodymium, uranium. Nope. It is neodymium parasidium oxide. Yes, that's the one you're going to hear a lot. Probably misenunciated. Better known as NdPr. NdPr. Now, with that in mind, imagine a business where the government is going to buy the next 10 years guaranteed of your supply. Not only is going to buy it, it's going to buy it at a guaranteed premium that right now is 30% over the spot market. Do you think so? Well, this company is headquartered right here in Las Vegas. And this company, when we put our recommendation out, was a week ago. I didn't expect this to catch fire so quickly. This company, we launched coverage at 46. I had it in the fund at 30, went up to 39. I'm just telling you how fast things are moving. This is crazy here. I get to the proportionality of it all. And it came down, I sold a little bit at 39, I'm a genius. And then it came down to 36, and I go, buy back. master trader here. And then wake up one morning and it's up 50%. That's on this announcement that I just talked to you about. The government's also given him $400 million. In addition to that, a couple like obscure bankers like Bank of America, Morgan Stanley, are giving them over $1 billion in guaranteed loans. Why? Because China's got 91% of the processing power of precious, what do they call, rare earth elements. And we only have here maybe 2%. So we're exposed, and it's a very strategic element, which I'll get to in a moment. Regardless, we put research coverage out in the stock about a week ago. It's at 46. Our target was 67. It closed today at, I think I want to say 58. The symbol is MP. So we're not that bullish on it. We're looking for a pullback, and then I could wake up and it's up 50%. I mean, it's just nuts. So what we have here is a flyover that I can't read. I'm sure none of you can see. Can anyone read this? Rare earth. Okay, so I'm going to say a few things about it. I was going to try to name the elements. Hey, Chris, can you scroll to the end? We have a couple of our analysts, our AI bots, did a discussion, a deep dive, and it's really just kind of describing what these rare earth elements go into. Things like the stealth bomber, your iPhone, anything and everything that you need is high tech, anything and everything that the Defense Department needs for national defense. It's huge. China has 50% of the known discovered supply. And these things, these elements are not hard to find, but they're so scattered and spread out. It's inexpensive to get at. And, you know, with the environmentalists in different countries, they haven't worried about it until now. But that's all changing. With the stroke of the pen, the administration has jump-started, kick-started this industry. The AI, strategic, uranium, rare earth element industry. The total right now addressable market value is about 9 billion, and that's expected to grow in the next 5 years to 36 billion. It's huge growth here. We're going to be looking for a lot of names. By the way, feel free to get up and get some dessert. Don't let Morgan get it. Morgan, save something. You got a plate full right there. No, those are all buns. All right. So if Chris will scroll to the end, he's going to launch this discussion. And if anyone can come up with three rare earth elements, but the key is you have to be able to pronounce it. That's the key. You'll win the door prize. Hey, Chris, can you launch that?
You know, it's making that screen so bright. Or maybe your electric car, how does it get that silent power? Or even just, well, the internet itself that's connecting us right now. What are those hidden ingredients?
Yeah, it's fascinating stuff.
Today we're diving into something called rare earth elements, or REEs. And here's the really interesting part. Despite that name, they're not like cosmically rare.
Not in the ground, no. They're actually fairly abundant in the Earth's crust, relatively speaking.
Right, so the rare part is more about...
It's about the difficulty. How uniquely challenging they are to first find in concentrated deposits and then to extract and process. That's where the real complexity and frankly the value proposition comes in.
Makes sense.
And what's really extraordinary about these 17 elements, chemically quite similar by the way, is their down to their electrons. These electrons are sort of tucked away deep inside the
Hey,
atom.
Chris, we're having some technical difficulties. Can you jack up that audio on your end?
Luminescent.
I hit the plus button and it went lower.
Robert, the audio doesn't play. It won't be able to play through my computer to your audio, your speakers.
Okay, so this will be available on our website. And if you're registered, we'll send this out to you for your own perusal. It's a deep dive and even a flyover of what's going on with rare earth elements. very bullish on that. So lots of ideas to follow. And just want to move to the final slide here. Hey, how you doing? How you doing? How are the links today, Richard? I'm kidding. Thanks for joining us. Thank you. Next slide. Is there a next slide? I think there is. No, it's the tear sheet. Oh wait, no, stop. This is another recommendation. Sorry, we're going to seat the pants for sure. But this is another company that we launched coverage on May 28th. $5.50 called Energy Fuels. And if you put these things have just caught fire. Now they're very small. It doesn't take a lot of money to move this. There's not a lot of rare earth element stocks out there to buy. There's more of a market share to be had. So this was at 5.5. What, about 6 weeks ago? And now it's at, is it 9? Did it close at 9 today? Like, since the government made this announcement and this huge commitment to developing rare earth elements here, so we're independent from China, these equities, no matter where they are taken off. I think that one is domiciled in Canada. This goes on. They've got the White Mesa Hill in Utah. By the way, MP that I first talked about, their asset is on the way right across state line. Mountain Pass. Does anyone know where Mountain Pass is? Well, you know where it is. On the way to California, right as you get towards Prim, I guess over on the left is where all that rare earth element mining happens. And they're, yeah, right by Gene. So that's where it all happens. And that's the only, in the whole country right now, producing site for rare earth elements. So there's a lot of growth ahead. This company has a place in Utah, and they're on the trail too. They do more of the, when you get the uranium out of the ground, more of the separating out the name I can't pronounce, the NPDR, neodymium, asperidium. Anyhow. Okay, so to the tear sheet, we're going to wrap it up here and open it up to any Q&A that you may have. Okay, so this you can't read either, so you can find it on our website. So I'll just describe it to you. We are very conservative in what we do here. I just want to stress that. There are 2 rules when you manage money. I know most of you know them, but they're hard to follow. The first is don't lose money. Don't let those losses run. Cut them quick. You can always come back and buy it again. But if it's going the wrong way, you don't know why, the market's going up, anything like that, are all reasons to step back and take a breather from it. You'll be able to think about it with a level head. Rule number 2, and it's hard to do too, let your profits run, okay? You're looking at a guy that bought Google in 2004 at a split adjusted price of probably 5 and sold it at 10, thought it was a genius. Where's it today? Where's Google, 120 or something? Let your profits run. So the key about our fund and the strategy we laid out before is a focus on risk management and a focus on being hedged, being short bad companies too, being short companies that are overpriced, and being short great companies that are greatly overpriced. I mean, everyone's has been talking about the Magnificent Seven. I'm fading it. It's ludicrous. It's priced, I'm going to just a couple numbers, 55 times earnings. The market is priced at about 16 if you take those 7 stocks out. So it's priced about 3 times more. And the growth rate is about 12 to 14%. Put that in perspective, there's a ratio, I won't bore you with all that, but it's about 50% over the norm right? So at a certain time, you've got to step back and go, yeah, these are all great companies, are all dominant, but at what price? At what price? If you look at what's been going on since May, they're not beating the market anymore. They're up a little bit, but they're not beating other things that I call the second derivative of AI, which are the user cases, the companies that power the data centers, utilities that connect and build the data centers, many nuclear mobile generators to build more power, to have portable power. Those are the companies that are growing a lot faster and outperforming in the market. And should continue to do so. So thematically, while managing our risk, we're going to be taking advantage of companies that lack coverage, looking for opportunities in these areas that have secular growth, which are AI, uranium, I want to say rare earth elements, and crypto. I'll say it, crypto. I mentioned this earlier, but big legislation is going to put MasterCard and Visa on the defense, because you're going to have the ability to see credit cards become competitive. They'll become decentralized, not controlled by a few banks. And lo and behold, you see rates on credit cards drop by half. Great for companies involved in the USD, the stable coins. Not so great for credit card companies. And that's a big area of secular growth, crypto. The administration's behind it. Okay, let's open it up for a few questions. We got time for maybe 2 or 3 questions. Maybe 4, maybe 5, it just depends. You over there in the back. Oh, wait. I thought you had a question. All right, so Richard, you've got to have a question. Come on, man. All right, I'll come back to you. You got one?
Yeah. So this was talking about silver and metals and everything. What do you put up, how much importance do you put on a lot of the companies, I think, like the last maybe 5 or 10 years when it was no price? There was a lot of consolidation, a lot of companies, older, smaller, medium-sized companies, Canada, and some in South America. That's something you look for when you research on these, see if they can level of basically consolidation, stuff like that. How important is that?
So the question is, of the remaining companies that have survived globally, do we extend our research globally to come up with ideas? Is that about right?
Yeah,
Kind of.
and also, how much importance do you put on
Yeah. In that category, the consolidations have been in the larger, I think, gold companies like American Barracks, some of those others. We're looking at small caps. We're looking at newly issued companies that have been SPACified and then they've been spun off, like MP Materials started off as a SPAC by a hedge fund guy. Boy, what do you know? Another hedge fund guy getting rich, right? But MP Materials was a SPAC. These companies also are listed, some of them in Canada as well. So there's Canada is known for a lot of minerals and gold and oil, natural resource stocks. So we'll go there wherever they are. And the smaller emerging companies are coming, a lot of them are coming from Canada. Yeah. Yeah, the currency's been really, really weak overall, and I'm always concerned about that. But I think the explosive growth potential, at least at this point, outweighs that currency risk, at least in the next couple of years. And concerned about interest rate risk on equity prices overall. But right now, it looks like we're going to get a couple interest rate cuts before year end. So that's not going to hurt the market. I don't know. I mean, you've got the tariff bludgeon that's wearing off. It's now becoming a good thing. And at our first dinner, we were talking about the cold shower, how the tariffs are a good thing because they're encouraging reshoring, massive infrastructure investing. And Doge, which I think was largely performative, but some of it's going through, again, cutting costs there. Overall, we think we're going to be looking at 3 to 4% GDP growth moving ahead into next year due to all these factors: deregulation, lower interest rates, weaker currency, too, and the AI secular growth driven by the AI. So we think you got to get used to a higher PE ratio on the market and much higher prices. Our target in 2026 is 7,500 on the S&P. So where are we now? 63, about 20% in 12 months. Not bad, but we're starting to see the market broaden out into these other opportunities that we love, that are undercovered, that are mispriced, et cetera. I think the Russell trades at a 30% discount to the S&P. So it's mispriced. Great question. All right. Okay. Yes, Mr. Smith. Yep.
I just wonder where else is the demand for silver?
Right. So it's kind of a lot of basic industrial uses, but besides those, well, those glamorous ones like iPhones and, defense. So there is a firm backdrop of industrial demand, widgets, tools, dyes. I mean, all the boring mechanical stuff that makes the economy run has a silver lining to it. And when there's capital investment, that increases it. So unlike gold, silver has an industrial, a fundamental economic driver. And right now, silver's trading at a 50% discount to its normalized ratio to gold. So something's got to give. If something goes up, maybe something comes down a little bit, or if something comes down a lot, the other one, something's got to give. Silver, the high for silver is 52, and it's still way below that. Yeah, and gold is making new highs as we speak. It's corrected a little bit. Crypto's going crazy again, too. About, what is it, 120,000 a Bitcoin? Bitcoin's trading right now. Jumped up. XRB's at 382. Okay, there you have it. Alternative assets, decentralized finance, big thing moving ahead. A couple of our biggest winners from last year were Canadian-based companies that when we had an SEC chairman that was less favorable in crypto, you couldn't even buy an ETF here like 2 years ago, remember? But in Canada, you could, and there were a lot of opportunities there. So one company that we got involved with is called Exodus, EXOD, and they make crypto wallets. Who has a crypto wallet? Nobody. Oh, you do for that XRP. Oh, both of you, right? What are the benefits of a crypto wallet? Cold storage, right? Right, your wallet. Trading, yeah. And how likely are you to get hacked? That's one reason to have a wallet, so you won't get hacked. So it's not, remember that firm that got hacked at zero? What do they call them, like 10 years ago, 15 years ago? Yeah, yeah, you wake up one morning, your Bitcoin's gone, your dog died, your truck's on gas, now you're dead. You know that one too. Yeah. Any more questions? Yes, the lady in red. Yeah, that's a great example. Canadian truckers, yeah. Yeah, the ex-premier Trudeau went on the warpath against the truckers a couple of years ago now and froze their bank accounts, but they said, not so fast, I've got a crypto wallet. Go pound sand, Trudeau. And they kept blocking the streets with their big trucks. Yes, another question. Ooh, crypto wallet versus, I don't know if we got apples and apples on that one. I think they're both pretty safe because we've got civic insurance. So the counterparty is the US government, right? Whereas your counterparty is your wallet. What if you lose your crypto wallet? I mean, okay. I was going to say, what if you forget your password? I mean, they'll do that for you, right? Oh. Huh. Hello, Kelly. Hi, Kelly. Help yourself with this, like, plenty of food. Thanks for coming. Not to, it's a very good point you're making, by the way. I just wish I knew more about it to comment on it. That one's like, honestly, I know Morgan Mom owns a lot of crypto. Morgan, have you traded any crypto? We used to play golf like 3 years ago, before Morgan joined the senior pro-am circuit. Have you traded any crypto equities yet? That counts. That counts. Congratulations. Yeah, gotta be flexible. Gotta be flexible. Any other questions, comments? Yeah, Mr. Smith.
So where does gold come into the fight? There's demand for gold, and why is it trading at $500 this year? It's over to 35. If that's demand for silver, gold, I mean, the gold goes into jewelry.
Thank you very much for coming. No, Hubble is a lead business writer for the Las Vegas Business Review. And I just want to, I just want to tell, did you hammer the casino owners the way you're hammering me? Yes, sir.
I'd like to interject the aerospace technology, one of the highest connectivity processes right now used is gold. So in all of our aerospace products, for connectivity, the highest and most cleanest process is gold.
Yeah.
So a lot like aerospace, you'll see gold boil on stuff or reflectivity, whatever they use it for. I'm not a scientist.
Yeah. They say that all the known discoverable gold is like what, an Olympic-sized swimming pool or something like that, or maybe the state of Rhode Island. I'm not sure which. Right, but back to your question, Mr. Smith. You'll you'll have to submit that by email because our gold analyst just left the building. He's not here. Yes, a lady in red. Yes. $1,250,000, 100. Take your pick. Couple bucks. It's 100,000. Yeah. Sorry to be so cool. If you can read the screen, you're a mile ahead of me. Does it say 100 there? 100, then it is 100. You betcha. Yay, Kathy. Yes. Yes, yes. I think Richard has a question. Oh, back. Yeah, would you please address this? Come on up here. Come on up here and address it. Okay. Richard actually is an ex-commodity analyst, Mr. Smith. Okay, they're having a discussion, but it's all right.
You were asking about what's the difference. What one of the things actually defined by the central banks, and, you know, and the concern about it. I mean, you saw it really run when they concerns about inflation started to now that's what's been like a lot of the main drivers with it, but silver again has a lot of more as well as actually healthcare uses too. So one of the purposes for silver was actually it's a natural antibiotic, or you know, just in terms of like if you put a silver coin in like a thing of water, it'll basically kill all the bacteria. So what they've been doing a lot in healthcare is like spraying like a silver covering in hospitals and stuff like that in order to basically, you know, keep the risk of staph infections and things like that down. I'm with I'm the portfolio like development manager for a group called Cardea Capital. It's a investment advisory firm. I'm local here.
110.
Okay. Do we have any more questions? The lady in red. How does a new investor get started in the movement? You read call. This is where it starts. I take it to the website and wait for Google or YouTube promote. Call me. Go to the website. All the documents are there. You know, it sounds like whatever the hell it is. Dash hashtag. Wait. God is BMC. Please don't remember that. Mr. Smith has a question. Off the record.
The 15% company a while ago, I didn't get you said it's not money. I had to know what that company did and why you thought they were worth investing in. That's all. I just want to know what happened to that. What was
The symbol was ABT. They did for construction. And they had no coverage, and it was a forgotten forlorn that became more forgotten before. And it's by me, very forlorn because it's failed. But it's just a little mispriced undervalued stock by a massive amount. We were wrong because it turned to be what we call a value trap. That is where you go, oh my God, this stock's at 10, it was at 90. Just because it's down to the high doesn't mean anything. Doesn't mean you should buy it, right? Lucent, right?
Like 75, 20,
Right.
all their revenues.
Right. Well, there's a stock called Amazon that went to $3 during the dot-com bubble. But you know, it started making money and the earnings and the revenue grew, and it's like $50 on the way to 1,000. So you can wait on these things just to make sure that they perform. Hey, more questions? Okay, thank you, everybody. It was quite a fun time. Thank you. Remember, rare earth elements and no, not that one. Okay, all right, let's mingle or not. And thank you very much again. And this concludes our 3-part dinner series in Las Vegas. Maybe we'll do it again. I don't know. We'll see. Thank you.